Today we're doing something really exciting. We're going to completely reverse engineer a fast-paced, high-stakes trading strategy from a seasoned trader with nearly 7 years of skin in the game. We're unpacking a framework that's designed specifically to navigate one of the absolute most volatile, unforgiving markets on the planet, and that is gold. We're going to dive deep into the source material to see exactly how the pros find their entries, how they decide where to take profit, and most importantly, how they manage their risk without losing their minds in the process. Okay, let's dive right into this. $566,000. Let that sink in for a second. That is not some yearly projection or a theoretical what-if model. That is a massive $566,000 profit generated in a single month. And you want to know what's truly mind-blowing about that? That profit wasn't spread out over hundreds of tiny, stressful, all-day trades. It was actually generated using just 2 live, heavily documented trades. We are going to look under the hood to see exactly how those trades were executed, but first, we kind of need to understand the underlying philosophy that made them possible in the first place.
And that brings us to the absolute core philosophy driving this entire approach. Get in fast, get out faster. Look, if you've ever watched the markets, you know gold moves incredibly fast. It can hand you a beautiful, highly profitable move in literally minutes, but it can violently reverse on you just as quickly. So the goal of this specific strategy isn't to play fortune teller and predict the entire day's movement or try to catch some massive 200-pip trend. Instead, it's entirely about hunting down the highest probability section of a move. You just want to catch the cleanest part of the trend, grab your profit, and get out.
To get us there, we'll follow this roadmap straight from the source. First, the gold scalping mindset. Then, the 5-step strategy. Next, executing your entry. After that, we'll do some live trade breakdowns. And finally, we'll look at the discipline cheat code.
All right, let's kick things off with Section 1, the gold scalping mindset.
It's actually really fascinating to contrast the typical beginner's approach with a professional's reality. When newer traders come to gold, they almost always treat it like a normal Forex pair. They hold their trades way too long, they use these ridiculously tight stop losses, and they try to ride the entire wave of the market. But as the source clearly outlines, gold scalping requires a complete shift in perspective. You have to be in and out quickly. You aren't just blindly chasing the price, you're actively hunting for liquidity, and you're targeting only the cleanest section of the trend.
Now, the crucial point here really revolves around that word, liquidity. We all know liquidity is basically the essential fuel that smart money uses to move the market, right? And physically on the chart, it sits exactly where everyday retail traders place their stop losses and their stop orders. The huge takeaway from the source here is how aggressively gold absolutely loves to sweep these specific areas. It'll sweep high, sweep low, grab all that liquidity, and then rapidly reverse direction. So successful traders using this framework, they never chase the price. They patiently wait for the price to come to them at these precise liquidity levels.
Which naturally brings us to Section 2, the 5-step strategy.
So here it is, the exact mechanical framework derived directly from the source material. Step 1 is align. You have to identify your trend direction, specifically making sure that your 15-minute time frame and your 1-hour time frame are perfectly aligned. If they're misaligned, you just walk away. Step 2, mark. You mark up your available liquidity and your points of interest, like demand zones. Step 3 is wait. Honestly, you do absolutely nothing until the price actually reaches your 15-minute point of interest. Step 4, confirm. Once the price reaches your zone, you wait to confirm a liquidity sweep. That ensures the trap is officially set for the retail traders. And finally, Step 5, target. You enter the market and you target the next logical swing high or swing low. We are not aiming for massive, unrealistic targets here, just logical, clean profit-taking.
Moving right along to Section 3, executing your entry.
When it comes down to it, you actually have a choice here based entirely on your personal risk tolerance. With an aggressive entry, you pull the trigger immediately after the price sweeps the liquidity at your point of interest. Now, you're definitely more prone to false breakouts this way, but because the price so often just rockets away after a sweep, you have a much lower chance of missing the trade altogether. On the flip side, with a conservative entry, you still wait for the sweep, but then you wait even longer for a structural market shift and a pullback. This is way safer from false breakouts, but the painful reality is you risk missing the move entirely if the market just decides not to pull back. The source highly recommends testing both out to see which one fits your own psychology better.
All right, let's look at some real-world data in Section 4, live trade breakdowns.
Looking at these metrics side by side reveals something pretty wild. Trade 1 on June 18th lasted just 1 hour and 20 minutes, and it netted $292,000. Trade 2,
That took only 44 minutes to generate $274,000. But notice the alignment here. Trade 1 had perfect bearish alignment across both timeframes. Trade 2 was actually misaligned. And look at the execution differences too. Trade 1 was 100% mechanical, following the rules perfectly. Trade 2 was kind of messy and required some serious gut feeling. Let's unpack exactly what happened in the source's data.
So trade 1 is what the source calls a 7 out of 10 mechanical masterpiece. It maybe wasn't the absolute best entry of their entire career, but it flawlessly followed that 5-step playbook we just talked about. The higher timeframes were completely bearish, the price pulled back to a supply zone, it swept the lower timeframe liquidity, and instead of just entering immediately, the trader actually played it safe. They waited for an additional bearish candlestick to form as ultimate confirmation of that selling pressure. They entered the trade, they put their stop loss safely above the protected high, and they took their profit at the next logical swing low. Simple, repeatable, and obviously massively profitable.
And then we have trade 2, the 5 out of 10 discretionary danger. The time frames were misaligned here. The trader took the setup anyway, and the price actually started moving against them. Now, what happened next goes against absolutely every rule for beginners. The trader actually temporarily removed their stop loss. Crazy, right? But why? Because after 7 years of staring at these charts, their subconscious pattern recognition knew exactly what the market was doing. It was a classic market manipulation tactic. They just knew the price was pushing up to sweep liquidity one last time before finally crashing down to their target. And they were right, and they made an absolute fortune. But the source makes this explicitly clear. If you are in your first year of trading, never, ever move your stop loss. Stick to the mechanical rules.
Finally, let's wrap things up with Section 5, the discipline cheat code.
Honestly, the single most crucial takeaway from this entire framework is this right here. Strategy makes you money, but discipline keeps it. You can have the greatest mechanical entry model in the whole world, but traders rarely fail because they don't know when to enter a trade. They fail because of emotional mistakes. They revenge trade after a tough loss. They randomly move their stop losses out of panic and fear. They risk way, way too much of their account on a single idea. It's almost never a strategy problem. It's a psychology problem.
So, to combat this, the source utilizes a platform they developed called EdgeFlow, and it's basically designed to act as a mechanical safeguard against human error. Let's look at these guardrails. The app automatically calculates your lot size, so you literally can't over-leverage by mistake. You can set hard limits on your maximum daily loss, caps on the risk per individual trade, and even set a maximum number of trades you're allowed to take in a single day. And the kicker? Once you hit those limits, the system actually locks you out from making emotional mistakes. It forces you to adhere to your own predefined rules, combining all of that with automated journaling so you can track your performance completely objectively.
Which really just leaves us with this final thought. We've reverse engineered how to identify liquidity, how to wait for that perfect sweep, and how to execute a hyper-fast entry in the gold market based on the source material. But look, all the technical analysis in the world won't save you from your own emotions. A mechanical strategy can pinpoint the perfect trade, for sure, but do you have the strict, unwavering discipline to actually protect your profits once you've made them? What psychological guardrails do you need to build into your own systems before you take your next step? Think about it. Thanks so much for joining me on this explainer, and keep learning.